The Australian economy is getting its momentum back after growing by 2.8% over the year to September, as the Turnbull government looks to ensure the indolent growth that started the year does not return after Christmas. Bill shock, or the fear of it, stopped Australians from spending across the country as a relentless focus on rising energy prices drove people away from shops, healthcare, hotels and cafes. Only insurance and financial services recorded any significant spending growth of 1.3%. The rebound from the weak 1.7% annual growth in the March quarter, the weakest figures since 2009, was driven by government infrastructure spending, but an even better result was hampered by weak household consumption, sluggish retail and negative balance of payments figures. The coalition is now dangling the prospect of income tax cuts in front of voters to further spur spending across the economy, after workers drew minimal relief from a 3% increase in employee compensation over the year. I would hope that Australians are feeling like they are in a position that they can go and celebrate this holiday season, Treasurer Scott Morrison said in Canberra on Wednesday. We intend to provide income tax relief whenever and wherever possible. Mr. Morrison said the soft household consumption was expected due to cost of living pressures, referring to rising energy prices, but described the overall figures as another positive set. The solid growth outcome in the September quarter national accounts has accelerated growth from 1.9% to 2.8% through the year, he said. This is above the OECD average and puts Australia back up towards the top of the pack for major advanced economies around the world. Australian Bureau of Statistics Chief Economist Bruce Hockman said increased activity in both private business investment and public infrastructure underpinned broad growth across the industries. Private investment has started to catch up to government spending as an economic driver in the last 3 months, recording its third rise in 4 quarters on the back of strong gains in engineering and mining. Electricity, gas, water and waste services added the most to growth, up 1.9 percentage points, while agriculture, rental and real estate services detracted the most from growth. Chief Australia and New Zealand economist and Capital Economics Paul Dales said the performance of the economy in 2018 will largely come down to whether stronger business investment can continue to compensate for weaker housing investment and consumption. Overall, these data provide more evidence that the economy is successfully moving on from the mining boom and bust, he said. We expect that to continue next year. But the combination of a weaker housing market and continued weak income growth explains why we believe GDP growth will be 2.5% next year rather than 3% as the Reserve Bank has forecast.